So very often, the best investment opportunities arise even before the earnings come up. The market values earnings obviously, and the market values expected earnings. Um, but sometimes it is possible to see that the company will do well even before the expected earnings come in. An example of that is, let's say, way back in the early 2000s, in late 1990s, the ferrol alloys industry went through a very, very rough patch because the price of power, which used to be as low as 1.5 rupees or 2 rupees a unit, went up to as much as 6, 7 rupees a unit. And the manufacture of ferroalloys requires a significant, you know, usage of power. So depending on the product, you might be using as much as 1,000 units or as much as 6,000 units of power. But the ferroalloys price is largely determined based on the cost of power in South Africa, which is the global price of ferroalloys. So Indian manufacturers of ferroalloys had a very tough time when the cost of power went up. But if you had analyzed the industry in the early 2000s, when ferroalloys prices started going up, you would have seen that over the last 5, 6 years, when the industry went through a very, very rough patch, there was one company which actually managed the situation very well. And it never had a loss in its business, whereas all the other companies had such large losses that they had to default on their borrowings, and they could have obviously not service equity. So this company from Hyderabad called Navbharat Ferroalloys, an analyst would have noted that it was the only company which continued to make profits through this period and continue to service debt and also pay dividends right through this period. So I went and looked at the company at the time to see why they were more profitable, why they were profitable in an industry where nobody was profitable. The reason they were profitable was that they had used the cash that they generated in previous boom cycles of ferroalloys, not to expand ferroalloys capacity, but to put up a power plant. And whereas other companies had used the money to expand ferroalloys capacity. Now, when they put up a power plant, they basically capped the cost of the variable cost of power production at as low as 1 rupee. You know, so even when power from the grid price was going up, it went up to 4 rupees and 5 rupees and 6 rupees. Their cost remained at 1 rupee, which basically meant that they continued to be profitable right through the cycle. Now, to my mind, that showed a good strategic approach of the management. That showed their, ability to allocate capital well and all that. So when ferroalloys prices actually started going up in 2001, 2002, because hydropower failed in South Africa and the price of power went up in South Africa, so the global price of ferroalloys went up. This company was in a position to capitalize on it brilliantly. So over a short period of time, over 3, 4 years, their profits actually went up from about 10 crores to about 400 crores. So they not only profited from the fact that their power cost was very cheap, so their variable cost was low, and as the price of ferroalloys went up, they could keep on making more money. They could they actually had surplus power also which they could export, and as the price of power kept on going up, instead of being a disadvantage, it was actually an advantage for them. The stock obviously followed and did very, very well because of that. So if you knew the industry well and if you knew the reason why the company was doing well, you could almost say that when ferroalloys price went up, this was the company which would benefit the most. You did not wait for the earnings to come in. A similar thing happened in, say, a company like Sesagoa. So Sesagoa at that time was the largest private sector miner of iron ore. And they were, but they had a tough time because the price of iron ore was very stable and very low at around 12, $14 a ton. And but they had brought in very, very good management, and it was originally owned by an Italian company that was bought over by Mitsui of Japan. Mitsui came in and tried to improve the operations by setting up water route for moving iron ore, and efficiency of operations was increased. So the cost of production was kept as low as possible. So even when iron ore price is very low, they didn't make much money, but they made some money, and they were running a profitable operation. But when post 2000, when China entered the World Trade Organization, and China started building steel capacity very aggressively, the demand for iron ore went up very significantly, and the price of iron ore went up from some 12, $14 to 20, $25 initially, and eventually went up to as much as $200. You know, now Sesako having controlled their cost of production so tightly, um, every additional dollar of iron ore price actually meant $1 profits for them. You know, they're already done that. So if you knew the company well, if you knew what was happening, you knew that the impact of iron ore prices would be disproportionately large. So if at $14 of iron ore price, they were making $2 profit, at $24, they'd be making $12 of profit. You know, so a 60% rise in iron ore price would mean 600% rise in their profits. You know, this was a good analyst, and this is what Buffett calls a circle of competence. You know, if you understand the industry well, if you know the business model well, if you understand the company well, when things happen which are favorable to the company, you're able to recognize them much faster and able to take advantage of that.